Chapter 2 of Auditing, we talk about the CPA profession. And the first section discusses the public accounting firms. So there's a nice table in the textbook, but the top four, or the big four, are Deloitte, PwC, Ernst & Young, and KPMG. And they really do the largest international, biggest companies. Then there's national and regional firms, which will also compete for those same companies, such as like Grant Thornton and BDO. Those are common ones. Then there's a variety of different local ones. And the local ones normally will have less than 25 employees. Sometimes it's only a couple. So there could be, there could be tons of local accountants all over the country. And some activities of those CPA firms are accounting and bookkeeping services, tax services, and then management consulting. And consulting is becoming more and more common in the CPA practice. The structure of that CPA firm is obviously anytime we're going through an audit or having the tax returns prepared and things like that. Many times the banks require it to be somebody who doesn't work for that employer, so independence or an unbiased opinion, because that person can use a level of objectivity and kind of skepticism and look through to make sure everything looks good. They also obviously are set up that they encourage competence for effective and efficient operations within that CPA firm. And there's definitely increased litigation risk for auditors, so they continue to experience lawsuits that come against them, and they also have to be able to afford to protect themselves from those types of lawsuits. So what do they do within their audits or within their services to make sure that they are safe from that? So a CPA firm could set up a variety of different ways. So these are concepts that you've probably covered in other business classes, but a sole proprietorship is a person who is self-employed. A general partnership is two or more parties that come together and basically are very similar to a sole proprietorship. So the benefits of those are that you have greater control. The downside is that you have complete liability. So a sole proprietorship, your personal assets are not protected. Neither are they with a general partnership. And then in a general partnership, you're actually liable for the debts and the activities of your other partners. So those are kind of the downfalls. The good thing is that both of those have taxes that funnel directly to the individual's personal tax return, so there's no double taxation. Whereas a professional corporation would give them personal liability protection. However, it's prohibited by law for CPA firms to become a general corporation. We can't sell stock and have investors and give dividends and things like that. So then there's a limited liability corporation, which is kind of the best of the corporation and the partnership. So you can still be taxed like a partnership or even a single member LLC, but then you do have that limited liability. Some professional individuals will form as a limited liability partnership, where they come together to take advantage of like cost efficiencies. So they could share an office, they could share a secretary, they could share a computer system, things that would be expensive to maintain alone. And then since it's a limited liability partnership, it would limit their liability of the partner's actions, not their debt, but their actions. Then we have the different regulatory bodies that oversee these, audit firms and these public accounting firms. So we have the PCAOB, which stands for the Public Company Accounting Oversight Board. So they were set forth by the Sarbanes-Oxley Act, and they are overseen by the Securities and Exchange Commission, and they set the auditing standards and the control standards for all publicly traded company. And they need to annually inspect their their records if they have over 100 public companies that they serve, and then every third year for companies that are smaller than that. So obviously the bigger, like the big four, are going to be annually inspected by the PCAOB. The Securities Exchange Commission, which is abbreviated to be the SEC, is the agency of the government that is basically providing investors like you and me with reliable information so that we can make decisions, like if we're investing money in our 401ks or our retirement funds, we can feel confident with the publicly traded companies because they have to file all these reports with the SEC, throughout the year, and they have to go through their audit, their independent audits. So an S1 is when they register new stock, so it's like initial public offering, or they're just adding new additional stock out later on during their as their needs increase. The 8K is if there's a significant event reporting, such as an acquisition, or a divestiture or a sale of a subsidiary. The 10K is the annual filing of the detailed financial statements. And hopefully, like if you've taken business finance, you've gone through and looked at a company's 10K, because those can be like 100 pages. It can be like a whole book. So there's a ton of detail that goes into them. And when I worked at the oil and gas company, that was one of my responsibilities, was to help the controller and the CFO prepare those 10Ks, which then again were sent to the auditors to be reviewed and audited. And then a 10Q is a quarterly filing of financial statements. So with the 10K and the 10Q, it's prepared by management of the company, but then the auditors come back and review it and test it and give an opinion on it. The AACPA is the American Institute of Certified Public Accountants, and that organization sets the professional requirements, tries to promote the accounting reputation. They have a code of ethics that the accountants are expected to follow, and their major areas are setting those auditing standards, the preparation, compilation, and review standards. We will talk about the other attestation standards. I always struggle with that one, like way at the end of the semester in chapter 25. And then like I said, the codes of professional conduct, or the ethical codes. The other functions that they have that they are responsible for is writing the CPA exam and grading it, and then providing continuing education or CPE credits for CPAs. And you can join the AACPA. It's a professional organization, and then you can get some discounted CPEs as a part of that. Then when we talk about international standards, it's the international standards on auditing, so ASAs, ISAs, and those are overseen by the International Auditing and Assurance Standards Board, IAASB, and then also the Worldwide International Federation of Accountants, so IFAC, and over 130 countries belong there. But so the U.S. standards, we follow the generally accepted auditing standards, and those are mostly consistent with these international standards of accounting. And the fact that there's these international standards of accounting, those don't override our individual standards, so like our generally accepted auditing standards. So, and then that's listed below. Again, that PCAOB is going to oversee the public companies, and again, they are using the generally accepted auditing standards. So then getting into the details of those generally accepted auditing standards, they discuss the purpose of the audit, which the overall purpose is to issue an opinion on whether the financial statements are presented fairly in accordance with GAAP. And then they also have a paragraph that explains management is responsible for the preparation of the statements, and the policies and the procedures that go along with their internal control structure. What the auditor is responsible for is having appropriate competence. So that could be education levels, certification levels, as well as job experience in that industry or understanding work experience in that industry. They obviously need to be compliant with all of the ethical standards that are set forth by the AACPA. And then they always, again, because they're independent, they need to be able to maintain a professional skepticism and then exercise good professional judgment. So, they're beyond the company's management, so they're outside of that window, and they can kind of look at it and consider what errors could be there and use that professional skepticism to issue the right opinion. Then their performance is obviously planning the audit, supervising the different levels of the auditors that are there, setting materiality levels, because in today's world there's so much data. There's no way they can look at it all. So they have to determine what is their level of materiality, and then how are they going to test within those levels. And then once they kind of make some of those determinations, then what is their level of risk? So say if they're only going to look at 20% of the transactions, how comfortable do they feel like those remaining 80% could have errors in them, and they're going to give an opinion and it could be wrong. So they definitely have to pull sufficient evidence, and that all goes back to like the efficiency and effectiveness, because you could be 100% effective by looking at 100% of the transactions, but obviously that's not efficient. So the auditor has to balance that, and that all goes into that risk. The quality control is, again, dealing with our policies and procedures of the CPA firm itself. So they do require that there's a technical review of the audits themselves, the CPA firms themselves, to ensure that they're following generally accepted auditing standards. And what they kind of look at when they test is the tone at the top. So does the organization have a culture of quality? And normally, especially like those big four, they have a very, very strong corporate culture, and they push it down to all levels of the audit team. So everybody's on that same page. And then if you're not, really, you would just find another job. So that's kind of the nature of that business, is it's a little bit definitely competitive. And if you don't promote, you don't just stagnate, you got to get out. But it all kind of again goes back to that organizational culture. They also test that they are following all the ethical requirements, so they are maintaining independence from the client that they're auditing. They have an objective opinion as they're looking at those financial documents, and they have integrity. So they're doing the right things and obeying the laws and the procedures and the rules. Human resources, again, that, because that's like the audit manager's job or the audit partner's job, is who am I going to put on this audit? Who's going to be the supervisor, the manager, and the staff level auditors? So you want to pick people that fit. So people who have experience in that industry, people who, understand what they're auditing, and that they have the right technical skills, and maybe if they're already a CPA, have they taken the right continuing education hours to help in this engagement? So again, human resources is picking those people that are on the audit. Then there's the engagement performance, which again, they're going to just make sure they're following all the requirements. And then monitoring, which is the annual test of that quality control system that the public CPA firms have to go through. A peer review is when another CPA firm is contracted to come in and review another CPA firm for their compliance with their quality controls. So the public firms that have the over the 100 clients, those are reviewed by the PCAOB. So if they're auditing large public companies, that PCAOB is going to review them. Smaller private accounting firms can select another CPA firm to review their records, and normally that's done every 3 years. There's also an audit practice and quality center that's established by the AACPA to improve audit practice and the quality of audits, and it enables people to go and research materials and go through training and things like that, so that their firms can be better. Okay, so that is chapter 2 on the CPA profession.